everyone. We're going to get started right away. We're going to let people start filtering in. Thank you for joining us with the fall version of AHA with Amplify. It's not weather appropriate to be calling it fall, but we're very excited that October's here and it's the third Tuesday already, which is crazy. So today we're going to talk about financial wealth and the post-pandemic, if we're ready or not. We're going to do some intros in a couple minutes because we see everybody slowly getting on to the webinar. While we wait for people, I want to give you a little update about what's happening with AHA. We're really excited to be in our third season of AHA with Amplify. And as many of you know, we are now recording the sessions so that they're available for you to revisit, or if by any chance you can't hit us up and join us for lunch now that you're back into the real world and the pandemic is maybe over. So very excited to be able to offer those recordings. We still ask that you do continue to join us live because that gives you the chance to ask us questions, and also you will get a CPD certificate by joining live. So thank you so much for attending live. Next month, during the webinar, the third Tuesday of November, we're going to be talking about leadership. So we're really excited for you to join us and talk about leadership and have some soft skills review with Erin. We also have a live event in November. The registration just opened and it's going to happen on November 3rd. We're really excited about this topic. We're calling it Take Back the Edge. And it's about the CFO and the modern CFO and how the CPA profession can take back that top job. What we know is that CPAs are only about 40% of CFOs these days, and that MBAs and CFAs and many other professions are quickly taking over that executive seat. And the question is, should CPAs be training differently and being prepared so that they can continue to dominate the CFO seat? Or is the world changing and we should actually be more worried about compliance like ESG and tax and financial reporting and all of the complicated areas that CPAs certainly do dominate in? So Take Back the Edge is a conversation about the modern CFO and what it is that we need to be prepared for if we're going to be in that executive seat. So that's a live opportunity in person, and only AHA members are getting the password. So please do take your seat because we do expect that that will sell out. Most of our in-person events do sell out. So November 3rd, watch for the email and register so that you can be part of a conversation about what it takes to be a CFO and how the CPA profession can take over that seat. Today, we're talking about financial wealth with Kurt. I'm going to pass it to him right away because we're getting everybody in and we're ready to get started. We're very excited to have Kurt here with us. He is a veteran CPA presenter. He speaks to CPAs across all of Canada with all of the institutions, talking about how we as business leaders can take advantage of this various tools and various advisory to help us with our own personal wealth and financial wealth. We also know that Kurt can share with us some information for those of us that work in companies with founders and business owners, because we know that there's a lot of gray between the corporate finances and accounting and those founders and business owners' personal wealth. So we are going to learn from him how we can be better in our seat as a corporate CPA or business leader and helping those founders and business owners be better prepared for their own personal choices. So there's a lot to cover today. We're going to have a really intense hour and then we're going to have questions and answers at the end. So please feel free to send those off to myself and Nikki in the meantime, and I'll facilitate them at the end. So without further ado, we really appreciate that you're joining us, Kurt. It's a very important topic and we're excited to learn more about it.
Hey guys, thanks for giving me an hour of your day. Pleased to be here to talk about personal finance, wealth management, and just who you are and how it all fits with you. We're going to blow through an hour real quick here. You don't have the slides. I'm going to put them up and go back and forth. So you're going to have to look at me a little bit. And diving right in to talk about kind of state of where things are at with your finances and overall. The whole presentation is geared to pretty much the only types of people that I deal with, which is white collar professionals, business leaders, entrepreneurs, executives. So I'm going to take you inside your own personal finances from a guy that lives in the trenches dealing with it every day, and just give you some things to think about. So sit back, relax, make a couple of notes. My understanding is the slides are available after the fact. And I'm going to go back and forth between them. If you've got any questions, put them in a chat box. And let's dive in. So let's start off with who the heck am I and why should you listen to me? So let me put the slides up to get started here. All right, you can see that now, I trust. So me, a little bit about me. I'm a tax CA, trained in Winnipeg with Ernst & Young back in the 90s. I moved to Toronto, co-founded the national wealth management practice for Ernst & Young in Canada. Had a lot of fun chasing millionaires and billionaires in the 90s. When I left, we were over $3 billion under management with investment assets. Wrote my first 2 best-selling books in Canada at that time, Tax Smart Investing. Since then, 7 books in the industry, 30 years. I'm 55 years old. In private practice, the last 22 with my own practice now, from Halifax to Vancouver, living and breathing white-collar finances. Regularly find me in the Globe and Mail, and I've been teaching for the CPA associations in 8 provinces. I'm in my 17th year with 6 different courses. So what you're getting today is a little bit of all of them in a power hour of what's relevant to white collar professionals. Let's dive in. Whenever I'm looking to the left here, it's just because I'm looking at my slides. Okay, guys, this picture here that looks like a pizza on slide 3. Make sure you guys don't have the slides. This picture here is, I have this on a glossy page, 11 by 17. It goes down on the table in every meeting I do, whether I'm talking retirement, buying a new home, children's savings, your mother just died, you lost your job, put it down. This is ground zero for all of you. You're in the middle. You, your partner, if you have one, your pets, your kids, your parents, your grandparents, this is your financial world. We're going around this circle today. We're going to talk about career. We're going to talk about taxes, estate, insurance, real estate, the biggest purchase of your life, your career, the engine of your money coming in for 40 years, insurance, investments, cash flow, and more. You guys ready to go? This is going to be a real quick 1 hour, trust me. So let's keep going. All right, let's start off with a bit looking back here. Why your grandparents or your parents' logic doesn't apply to you. It's a different world today. And when you read the points on this slide, it's so different today. We'll have 6 employers. The kids don't leave home till we're 35. We spent the most for real estate of any generation before us to buy a home in relation to total income. Simply put, you are more alone than any generation before you in taking care of your financial affairs. You cannot delegate authority to somebody else. You could get someone to buy you investment products or sell you insurance, but you need to be more involved than any generation in the past because it's complicated. And, effectively, nobody here has a hydro pension for $125,000 a year, or maybe a couple of you, or you married into one. But ultimately, in every corner of your finances, it's more challenging. There's less money to go further, and you need to watch it all. And we're going to step into all of this today and build this out to give you a sense of, okay, what is he really talking about? Financial knowledge, literacy. So I spend time mentoring and coaching high school kids, university kids, and I'm still in shock that Canada-wide, there really isn't much financial literacy taught in high school. So we head into our 20s, with our parents doing our tax returns till we're 28, barely starting investments, getting credit cards, but it's just shocking how low financial literacy is. And it never really stops. I'll sit down with a 60-year-old couple. And for example, just to pick investments, I'll say, put all your investment statements on the table. There's your group plan at work. There's your RSP. There's your TFSA. There's your spousal RSP. There's your wealth. Tell me last year what your performance was across all the accounts combined. Tell me what your fees were last year. Tell me what your risk level is. How much of all of it's in the stock market? Tell me how tax efficient it is. What's your return in the last 5 years versus the market? They'll say, These are educated white collar professionals that simply can't even tell me where they're at with their finances. Never mind tying it to their freaking goals of how much do I need for retirement? 2 million, 4 million, 6 million, 8 million? Am I on track? We'll come to that, you guys. So financial literacy and the psychology. So money literacy is not taught anywhere. It's still very much a case. I got a couple, one comes to the meeting, the second one doesn't show up. I get it. We all allocate responsibilities in our household. Someone shovels the snow, someone cooks, someone does the laundry, someone pays the bill, does the tax return, manages the investments. Do the work, but don't give up control and knowledge of what's going on. You should both be at the table for strategic things like how long do we support our kids? How much real estate should we really buy? What will retirement look like? Will we help out our aging parents? And whether should we have 2 jobs or 1 job? 2 paid jobs. Those are all strategic decisions where both people need to be at the table. Many people don't budget or save enough. Many people don't have estate documents. As much as 50% from my survey don't have a will. And I mean at 50 when the kids are already 18 or 16. So overall, a lot of people don't have adequate life insurance. It's really a case of whether we're just too busy, whether we don't want to deal with this, or it's a little bit of everything, right? But point is, when you combine that with the previous slide and say, yeah, but life's harder and busier and more expensive than it's ever been before, we need to be more on top of this, I'm not seeing it. So then you get into relationship financial. And, nest building. Nest building is when you start to kind of get married, maybe if you do, have children if you do, buy a home if you do. When you think about life today, between 27 and 33, a lot happens. Typically, you're looking to finalize the job you hope to have for 40 years. You're about making the biggest purchase of your life in a first-time home. You're taking on the biggest debt of your life in a mortgage. You might get married. You might create new people, all within a pretty tight range. And so, none of that is buying a stock. It's real life goal planning, decision making with financial consequences. You're not going to get those answers at Quest Trade. But the fact of the matter is, who do you talk to? You go to the brokers at some of the institutions. Sorry, do you have $1 million? You don't have $1 million, go away. You're getting sick of talking to your folks. So overall, there's a gap at the busiest time of your life where you need concrete advice. And you know what? If you never get it, you're 40 and you're still the same way. And that can't happen because 40 is my line in the sand. You need a plan by 40. I'll come back to that. Your parents could be elderly by the time you're 40. Do you know where their will is? Their real will, not the copy. Life's biggest events, no one offers guides, over-reliance on technology, right? Robo discount brokerage. I'll talk about investing last today, if we have time. It's so unimportant. You need structural planning tied to your goals, integrated across all the different planning areas: career, taxes, retirement, estate, risk management, investing, family, debt, real estate. You need to link that together, have a plan first, and plug the products in last. The easiest way to see a fake financial advisor is all they do is sell you products. That's the last thing you need. You need structural financial advice at the 30,000 foot level, the 3,000 foot level, and then down into the products at the very end, which is why it's the last thing we'll talk about today. All right, let's start with goals. Let's talk goals. Because isn't this what it's all about? Is, Kurt, I want to reach my goals. Not quite. Your finances are 2 different types. Goal-based planning only covers off, I want to retire someday. You need a goal on how much to save and how much income to have. I want to support my children to financial independence. Yes, that's a goal. And I want to be debt-free. That's a goal. So you have 3 areas, if you do all of that are goal-based, where you should quantify, put up goalposts in the distance, and measure your progress towards it. Are you doing that now? Or are you just flying by the seat of your pants, buying products and hoping? The rest of your finances is not goal-based. Getting a tax return done, buying life insurance, getting a will. That's not a goal. That's a housekeeping task. It's equally important, but it's important to differentiate because it ties to how you pay for it overall. So let's talk about goals. You know what floors me? I'll talk to people that are 40, 50, 60, 70 years old. And I'll say, you know what? You've been investing for 20, 30, 40 years. What's your goal? Well, what do you mean? My goal is to make money. No. That's not what I'm asking. Let's use your children's savings. Let's say you're 42 years old. Your children are 10 years old. You're trying to save for what? Post-secondary education, age 18? How much do you need? I don't know. You need $125,000 if the child's going to do a 4-year degree out of town. And that's in 2022 dollars. Work it backwards and you'll quickly see that putting money to an RESP ain't enough. So overall, you need to quantify the goal. So on this slide here, you need to define the goal. I want to support my kids. Timeline when? After age 18, how many degrees? 2, 3? And then what's it going to cost? And then you work backwards and you put the dollars in place and you buy products to suit that. But, most people just open up an RESP, get the social insurance number, put $2,500 in, buy some products and hope. That's not a plan. That's what's wrong with the industry. You're just buying products and hoping. So, and then you got to evolve them. I did a retirement plan 3 hours ago with a guy who's 61 years old. and he wants to retire next year. I showed him he cannot retire next year at 60 years old because he's about $500,000 short from the $125,000 a year after tax he wants to spend net of CPP in old age. This is all math and taxes. This is, what financial folks are geared to do. It's not products. It's math and taxes, you guys. So my point on the slide is few advisors ever quantify the goals. They don't have these skills if they're investment or insurance people. Accountants do, typically. And more accountants should be in financial planning. That's a whole nother story. Let's keep going. So that's goals. Define your goals, quantify, timeline, and sometimes you just don't know when retirement. Well, I hope between 60 and 65. Good answer, because the days of having a defined benefit pension and maxing out at 58 are gone for 85% of us. You got to be flexible. And the real answer is you retire when you have enough money, not just because you're sick of it or you're the commuter, all that stuff, because it's a long 40 years with no vacations if you didn't retire with enough money. So let's move on. Cash flow. These are all sequenced in a way too. You start with goals. Now we're into cash flow. Cash flow is what I call the blood of the system. You make it in your paychecks, you pay taxes, you disperse the rest of food, fun, debt elimination, and savings. 4 things. And the decision-making of how you allocate it can be one of the biggest struggles we all face. Because it's like, Kurt, I got a bonus. It's January 15th. I got $5,000. Should I pay down my mortgage? I'm behind on my RSPs. I should really put in the kids' savings. I know I should buy more life insurance. I could really use a vacation, Kurt. Strategic challenges, right? And someone might want a sports car. Someone may want to, redo the kitchen. And even spousal fighting can result on this. But this is really the front lines of everything is cash flow. Because we've set everything on automatic payments, car payments, house payments, everything's a payments world. Now you put your utility bills on payments. You get desensitized to how much money you have or don't have. What I'm finding is that, nobody needs to budget. I'm not saying the only time you need to budget, I hate budgeting, the B word. Nobody needs to budget. If you're doing it, great, but you're 1 in 10. And the only folks that need to budget are really where you're cash flow negative and you're going backwards and you're putting too much money on a line of credit and it's not getting any better and you're spending beyond your means. But everyone else can live within their means. There's money in your paycheck and your bank account. It's just a question of, are you getting ahead enough? And so it comes back to, are you quantifying your goals? So what are you doing? So let's say you're maximizing your RSPs. You're putting away the 28, 29,000, or you're doing it at work. Why do you think a white collar professional only has to save an RSP limit? That's not a white collar limit. You make $100,000, $200,000, $300,000, $400,000 a year. I sure hope you're saving a lot more than that. A lot more than that. And TFSAs at $6,000 a year, it's pennies. Let's be clear here. Savings goals are proportionate to your income because you want to replicate that lifestyle in retirement. I wrote a long form post on LinkedIn about 3 years ago saying, how are you managing the gap? The gap, I wrote that after doing yet another executive retirement plan for a 55-year-old where they're making $200,000, $300,000, $400,000 a year. They're spending all of it, home, vacation property, kids in private school, nice vacations, 2 luxury cars, you know it. New iPhone every year and a half, but not just for them, for the whole family. And so then I calculate where they're going in retirement. Beautiful real estate, but you can't buy food with your eaves trough now, can you? But their portfolio savings was low. Don't get me wrong, over $1 million, it's nowhere close to being enough for someone making $300,000, $400,000 a year and wanting to keep it that way. Remember my slide, we're not our grandparents anymore. No one wants to live on 60 grand a year and wear the same clothes for 18 years. So I wrote the story about the gap is how white collars that have great income in their 50s are facing a monumental decline into their 60s and 70s because they didn't save enough liquid wealth to buy food with and have fun with. And the answer of, well, I guess I'll keep working is happening now. The real retirement age is quickly shifting to 70 from what I see. Otherwise, it's a rude awakening that, yeah, you're now living on 80 grand a year and vacations are now camping. Nothing wrong with camping. So cash flow, you guys, is the name of the game. Mortgages with a 30-year amortization, whose idea was that? It should match up with when you retire. And yes, you could take debt into retirement. That's just your vacation money. Now you're putting more of your retirement cash flow into debt. That's not a good idea. So overall, cash flow is the front lines. And I go to every meeting with a 3-year summary. Last 3 years, 2022, 2021, 2020. Here's what the plan said you needed to save. Here's what you actually saved. And did you hit the targets or are you off? Because this isn't about right or wrong. I'm not shaking my head at anybody. This is about giving educated people information to make the best decisions for them. That if retirement's not going to happen, it's better you know about it in your 40s and 50s than at the doorstep. Because I know the bank will make you pay off your mortgage. You will take care of your kids because you love them. But no one's thinking about retirement anymore, and it's no longer guaranteed when everybody got defined benefit pensions. Let's keep going. So, career design. So we're going to work our way around that picture now and go through all the different wedges. Career, the engine of your money coming in for 40 years. So things like, should you have 2 incomes? 1 income? How long does maternity leave go? You know, I think what I would say about that is you're going to make your own decisions for you. What's good for you and your partner and your family, of course. I'm just the financial guy, but I know my role. And if you want the nice things in the 50s, 60s, 70s, and 80s, it probably takes 2 incomes in Canada today to do that. When you factor in not only you two, but how long you're going to support your kids. You in for house deposits now? Because it used to be on their wedding day, you'd give them 25 grand. Now you got to add a 0 to that. And that's, you know, that's just a different world. So overall, I'm convinced 20 years from now, all the healthcare and retirement you'll be paying for, there'll be no more insurance you can buy for dental and drug and stuff like that, at the way it's going now from what I see behind the scenes. So I think you'll debate, or you'll make the decisions on 2 incomes or 1. And then look at the bottom points here. Did you pick the right place to work? You know, that's an interesting twist, isn't it? Like, Kurt, you telling me where I should work? Kinda. I'm regularly looking at, you know, compensation packages, levels of income, executive compensation, pension plans, health and dental perks, executive, all that stuff. And I'm looking at what you could get over there. And I'm saying, you know what? Yeah, if you could change it over there, hey, they got a pension plan. Maybe you go over there before you're too old. So yeah, all of this, which is, again, how did I say it? The engine of all your money coming in for 40 years. Make the right choices, get it straight, because maybe sometimes the answer is your income's too low. Let's move on. Pension plans are lacking in company stock. I've covered all of that stuff. Healthcare stops when you leave. A lot of people are surprised. Or what do you mean? What do you mean I lose my dental and health plan when I retire? Yeah. It is almost nowhere now in Canada that still offers that. You're looking at $300, $400, $500 a month for you and your partner in retirement, which could be 10% of your take-home pay, which is pretty shocking. If you go, next time you go to the dentist, ask the person when you're paying with your magic little card, how many people pay cash to the dentist, and you'll probably see it's about 60, 70% of anybody over age 60. Beyond that, around age 50, I do 3-4 severance analyses a month. Have for 15 years. It picked up in the pandemic as people got let go. But it's remarkable what the tight age ranges I see. It's almost universally 48 to 55 years old. If you are, you know, the senior person on the floor of the big company, if you've got the biggest income, if you've got the old healthcare plan the kids don't have, if you've got the old pension plan the kids don't have, they're coming for you. And it's going to be darn hard to replace that income if you're making 300,000 plus and you're 54 years old. At the same time, you got 2 kids in university, you still have a mortgage, and you're behind on your savings for retirement. What are you going to do? And my answer is, to use a good prairie term, is you make hay when the sun shines. Is that when you have that big income, you get ahead on a lot of that stuff to the best you can and balance it with, of course, you still got to have fun along the way. I'm not, you know, just business. You got to have some fun along the way. So there's career design, you guys. Maximize, make sure it matches up with your goals for spending. Usually you hear speakers like this say, well, cut your cost and live within your means. Could do that too, but that's not fun. I'd rather say, are you sure your income's maximized? Are you sure your 2 incomes are maximized? Let's keep moving on. Real estate. Oh boy, where do we start here? Next summer, I think, is when we face the reality of what could be a massive correction, assuming interest rates stay this high. I've got 65 clients with mortgages that are 7 digits. And, interest rates have gone up at least 3% this year, but they don't all reset right away. So the comment I'll make on real estate, and really less about where we are right now, just strategically again, is it an investment or is it a place you're going to live in? Because we just lived through a decade where people plowed tons of money into the real estate, bigger homes, upgrades, vacation properties. The biggest challenge I'm seeing, the busiest part of my practice is retirement planning. People that are, saying I'm 48 to 54, I want to retire in 5 to 10 years. Show me if I'm on the pathway. Do that modeling you're talking about. Okay, we'll do that. The biggest challenge I've had for at least 5 years now is people will have they're asset rich and cash flow poor, meaning they got millions in real estate and 2 sets of property taxes and 2 sets of utility bills, and they can't live on what they're putting away on the security side. The second thing is, well, even if they say, well, I bought 3 rental properties. The similar challenge I'm seeing there is, yeah, but you bought them in your 40s and 50s. They're not going to be debt free till you're 80. And so you're not going to have any free cash flow. And if you're not making 4% profit, how do I buy food with money that's going towards a mortgage? So unless they're paid off, they're useless. Sell 2 and pay off 1. Now we're talking. And vacation properties, even if you say, well, we're going to keep the vacation property as long as we can, and then we'll downsize. No, you're not. Your kids want the vacation property. So we won't have it for your nursing home at 92. Now what do we do? So overall, real estate is the case. Find the balance. Whenever we do a retirement plan, we'll do it leaving all your real estate in scenario 1, we'll do leaving all your real estate as to see if you've put enough away through pensions, CPP, and savings to live the life you want. And then we'll do scenario 2. Nope, you got to downsize the home at 72. We don't want to downsize the home at 72. Okay, then cut your cost of living by 40% at 72. Otherwise, you're broke at 92. The math doesn't lie, in doing these simple scenario analysis, but people need to do it first versus just rushing out and spending it. And so overall, second property realities on the slide, most people cannot afford a second property. Unless it's inherited, most people cannot afford. You got 30 years from 30 years old to 60 years old to pay off your home, probably accumulate 1 to 2 million for retirement, and put your kids through post-secondary at $125,000 each in 2022 dollars. How do you squeeze in another piece of real estate unless you're making 4, 6, 800,000 a year? I guess you could tell. Next slide here, debt. Put this back up. So I saw a statistic yesterday that Canada is now the 3rd heaviest indebted nation in the world per capita. And I believe it. I see this all every day at every level. It's the case. It's gonna be, as I said, it's gonna be interesting to see what happens in the next couple of years. The point I'm making is to get to zero debt and when. I already said it in the mortgage comment, right? Is that, effectively you could go into retirement with debt, but it just means there's less money for other things. And if it's already going to be a small pool, then you want to make sure that, less debt is better, right? Lines of credit, mortgages, car leases, all of this is a challenge. And the attitude of the last 10 years was, why would I pay down my debt when it's 1.5% when I could go and take the money and buy real estate or Amazon stock? And the answer was because you could pay off pure capital. With almost no financing costs, you could pretty much clobber this real fast. But a lot of people went the other direction, right? And I guess it was just a case that we never thought this day would come. But now that it's here, you get whacked on all sides, right? Because the real estate's down, the stocks are down, and the interest costs are up. And simply to focus on the fact that mortgages that were 1.6 are now 4.6 is now going to slow down your ability to become debt-free. So I'm still focused on simply the goal of being debt-free in retirement. It's now making it more challenging and exponentially more because the financing costs are back because we did not accelerate payments in the last 5 to 10 years. It's too late to change it. I'm not, criticizing anybody, but the perspective always was pay off your debt. Pay off your debt first because you're using other people's money to get ahead. Beyond that, we'll see, effectively, by 50, 55. Ideally, if I can still make it happen, I like to see people debt-free by 50. Because typically, if you had your children at 30 years old, they're going to university when you're 48, right? And so you've now got the next 5, 6, 7, 8 years. How many kids did you have? Where effectively you need to focus on topping up tuition and helping them get through school. So it's like, get the debt out of the way, focus on helping the kids out through university, and all the way along, RSPs and TFSAs and more for retirement savings and squeeze it. And hopefully you're at in your 50s peak income that you can fit all that stuff in. It needs to be quantified because as you can imagine, it can get lost in translation real fast, but it's just an income statement and calculating the numbers, right? So let's have some fun and talk about kids. So we just finished our first 30 minutes, you guys. Does it feel like you've been with me for 3 days?
We've learned that much.
So, and you can pick on the Leafs, Maple Leafs all you want, because I'm a Jets fan, being from Manitoba. So I cheer against them too. Won't tell anybody. Okay, let's talk about kids. So we're moving on. We're moving our way around the circle, back to that pizza, and we're talking about kids now. We've just done careers. We've done debts. We've done, I skipped taxes. We did cash flow. Now we're on people you love, right? RESP, saving for children or grandchildren. We oversee about 270 RESPs for clients. So we are in this world heavily. And when the kids go to school, we see all the expenses. We're kind of the gatekeeper, and then we send you your money back to reimburse yourself once the kids are, well, right now we got about 20% of the plans that are drawdown as the kids are in post-secondary, including my 2 daughters. I'm not going to take you into this in detail. I'm going to focus more on the things you may not know. So let's start with a zinger. Do you have a kid who's 16, 17, 18, 19 years old? Maybe. And if you do, if you look at the RESP right now, if you looked at the investment statement for it, I sure hope they're not in the stock market. So, because you know you're down at least 20, 25% this year at a time where you're writing the tuition checks out. So if you're in the stock market and the kids are already at the finish line, 17, 18, 19, 20, what were you thinking? The time to be in the stock market is when they were 2 and you could weather the volatility. When they were 12, you were starting to scale down. When they're 16, you were majorly, what are you scaling? Bonds and GICs, safe stuff. By 17, you're in cash, which would have put you in cash by now. And then you're done with the stock market. You know, that's it. That is common sense. That you're not in the stock market unless you have a couple of years of runway time. That's called asset allocation, where you shift from equities to fixed income and change the mix over time. It's different for your retirement, because after you retire, you got 30 or 40 years to live. So you may scale it back, but never to cash the way you do with your kids' money. So how much are you trying to save? Let's go back to this slide. I know you don't have the slide, so I'll kind of read you guys the points. Right now, post-secondary education outside of your community, if they got to live somewhere else, room and boards, about $125,000. It could be higher for specific professions, and that's just the first degree. That's 4 years. So depending on where they go, how many kids you have, and ultimately how long you're prepared to support them, you're looking at, you got 3 kids, $375,000 now. Inflation in education is among the highest. You think food inflation is bad? Inflation in children's savings since we all went to university, 300% a decade. So it's going to be higher. So then I'll tell you, the RESP ain't enough. The system's not big enough. $2,500 a year plus $500 of grant money and a 6% average return gets you to about $90,000. You're not there. I know what you're thinking. My son and daughter will work. They will work like I did, but I get you. So did mine. It's not enough. $5,000 a summer ain't a difference maker. You're in for some money here. It's coming out of your paycheck, typically in your 50s. When I'm saying, more into the RSPs, please. So just be ready for that. So your choices are deal with it out of your pocket. They're not going to get student debt or effectively save more now along the way. A lot of people use their tax-free savings accounts as supplemental children's savings when the parents are in their 40s. What kind of RESP did you open? Did you open a self-directed plan where you're buying stocks and bonds and mutual funds and ETFs? Good. Or did you get pulled into one of those scholarship trust plans? Hope not. Those scholarship trust plans shouldn't even be allowed, in my opinion. Those are the ones where they talk in terms of, you ready for it? Units. You have units. If I just hit you between the eyes, I'm sorry, those are the worst plans on earth to be in. I hope you get all your money back. Google them. Google pooled RESP scholarship trusts. Google Ontario Securities Commission, Google Toronto Star, and read the comments on how much of a disaster these are. And you know what? You can't get out. What about grandparents putting money into the RESPs? Do you have your grandparents kicking in some money? Did the grandparents actually open the RESP for you and you let them run it? No, that's not a good idea. Let them put the money in, but don't let them run the plan. Why? Well, how old will your father be when your 1-year-old is 19? Will he be 93? Will he be around? He is. It's not a good idea to have the grandparents as the trustees. Let's remember, an RESP is a trust. It's not an asset, it's a trust. And the fact of the matter is you and your partner, if you have a partner, should both be as joint holders of the RESP, not one parent, both. And the grandparents should turn it over to you. They can still put the money in. They can even manage the investments with the trading authority, but they should not be the trustees of the plan. You're just asking for estate issues when they're gone. How many kids should you have? There's no area I won't go, you guys. In our 1 hour here, I'm going everywhere. The bottom on that slide here is how many kids should you have? 2, 1 or 2, not 3 or 4. Why? Because if you got to put 4 kids through university at $125,000 each, you need $500,000 to $600,000 around age 50. Then are you also going to pay for weddings and house deposits? You're never retiring. And you guys know I'm kidding, right? Because you're going to have as many kids as you want, no matter what the guy in the suit says. But as the financial guy, I am dead serious. Is that you better be realistic about what you can afford in all of your major life goals if you're going to have a big family. Let's move on. I'll put this back up because you guys need a break from me, no doubt. Anybody saying where's the red wine yet? Overall, life insurance. Let's move on. We're moving around the circle. Now we're into the world of life insurance. Well, this is a 3-hour conversation between this and the next slide, which is disability. I've got 5 minutes to make an impact on you guys related to life insurance and disability insurance. The first thing I'll tell you is if the prime time for both of these is when you got little kids and a mortgage. So pretty much 30 to 55 years old is when you have the most insurance you're ever going to have because you have the most risks in your life. After that, it fades away. Before that, you don't really need it as much. But from a life insurance perspective, whatever you get through your employer is junk. Okay, it's 2 times your base pay. It's not going to be enough for your dependents. You need extra coverage. You look at associations. If you look at private industry, make sure you shop at least 5 companies, at least 2 agents. Never ever buy from the first person you sit down with. Overall, how much do you need? How much do you make? It's designed to replace your income and take care of your family if you died on the highway last week. So you make $100,000 a year, take home 80. You buy $1 million, you just bought them 12, 13, 14 years, and then it's gone. So how old will the kids be? Is your spouse also in the workforce? You always want to pay off the mortgage. So if the mortgage is $300,000, add another $300,000. You always pay off the mortgage, and you rarely buy the bank mortgage insurance. You buy it on your own typically. So, and then what kind of insurance? Term insurance, term 20 insurance. Just cover off the period of dependency of your kids and a bit more. Cover off the mortgage. 20-year term insurance based on the income typically. But to be out there with just employer and having kids and a mortgage, you are nuts. This is not expensive for anybody in their 30s, 40s, or early 50s. It's affordable. If you buy term insurance, did you buy permanent insurance where you're buying insurance for paying out when you're 90 years old? Who needs that? Unless you own a small business, why do you need permanent insurance when you're 30, 40 years old? Yeah, and believe me, I get the whole tax shelter thing. I get all of that, overall, but factually is if this is a risk management tool, you need to cover off term insurance, super cheap. Because don't forget, you got a lot of things tugging. Let's go back to cash flow. You got a lot of things tugging at your paycheck. We need to put as little as possible into life insurance, a bit more into disability insurance, a bit more into your children's RESP, your RSP, your TFSA, and probably more than that. We need to accelerate the pay down of your mortgage, and you got to have fun. You need new cars periodically. Things always break in our houses. You do not need to put Cadillac level money into life insurance, maybe ever. So that's life insurance, you guys. Let's go to the next page, disability insurance. I would argue that disability insurance is the most important kind of insurance you will ever own. Because disability insurance is the insurance that pays you your income when you can't work. So physical or mental, if you cannot work, you make an application through your disability and they pay you a portion of your paycheck. I find disability insurance is the least understood. I say to people, do you have disability insurance? I think I have it through my group plan. Yeah. So let me get this straight. You know your dental plan inside out, but you don't know anything about your disability insurance that could save your life. I would never, I'm saying that to you guys, my buds here today. I would never be that direct in a client meeting. But, disability at work is also junk. Let's be clear. Your employer has put it in place as a basic perk because you were looking at 3 jobs when you started working there and they all had it. So to not have it's a bit of an unusual thing. Culturally in Canada, we have Damn it, we deserve a healthcare plan. I get drug, I get dental. The first thing we look at is, what's the dental coverage? Ooh, it's only 60%. That's not great. Like, that's just how we think. But disability insurance, you guys, typically they pay you about 60% of your pay. May or may not be taxable, so it's going to be a big drop. May not include bonuses or any variable comp. Might just be core pay. You have a corporation, pay yourself dividends. May not cover that. And so, can you live on 20, 30, 40, 50% of your current pay and still cover your mortgage and everything else? Probably not. On a core basis, depends. It's the right way to do this is a written needs analysis where you analyze the variables of the plan and say, okay, here's your actual income. Could you make that work? No way. Okay, you need a top-up policy. But what I'm here to say in my 5 minutes with disability insurance is your group plan's not enough, guys. You need to look at how to enhance it, higher income coverage, make sure it pays to age 65, make sure it covers all the various income types. And 2 words I want you to write down are own occupation. Disability insurance comes with 3 definitions: any occupation, regular occupation, and own occupation. Own occupation is the best definition of disability. In other words, if you make a claim because you can't go into work because you fell down the stairs, and they look at your policy and they see whether it's own occ, regular occ, or any occ. If it's any occ, which is the junky one, if you can go sell donuts at Tim Hortons, you're not getting any payments because you can do any occupation. Therefore, go do that. We're not paying you anything. So you want to stay away from any occupation clauses or definitions. Go take a look at your group plan. You'll see. Moving on. Retirement. By age 40. A lot going on here. I'll walk you through it all. You can take a quick look at the slides, but I will give you your 30s to get your life organized. Meaning, get the job you want for life, buy the home you think you want, get the mortgage in place, have the kids, get through maternity leave, have some fun along the way. And then by 40, though, when you're now time to put down roots, let's just reflect for a moment. By 40, you're probably halfway. Your children could be 8, 10, 12 years old. So you're halfway to their education spending at age 18. At 40, you might be, 20 years from retirement. That's not a lot of time. Trusted from a guy who's 55 like that. I still can't believe it. At 40, your parents probably are in their 70s and you're seeing them age and all the issues related to that. So it's a pretty important point where you should be putting a stake in the ground and saying, I need a plan. I need strategies. I need goal definition. I don't just need products, right? So let's run through some of these things. This is the busiest part of my practice. It's like people wake up in the morning on a Sunday and they look at each other in bed and they pop and say, hey, honey, I was talking to George down the street yesterday. George is retiring next year. Where are we with that? How much do we have? How much do we need, right? And your partner says, never mind, George. Our oldest is starting university this September. Is that RESP thing going to be enough for the 3 kids? And we still have a mortgage, honey. Our parents didn't at this age. It's like life's big 3 goals kind of wham, 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 all at once around 50. So it's like, whoa, people realize I need some structure, right? And the guy down the street selling me products and talking markets just ain't enough. He's never once in 30 years asked me what my goals were. Well, it's because he's a salesman. He's not an advisor. So overall, 40 is the age. So what are the things we need to think about? Advanced career, higher income, maternity leave over. Are you maximizing your career? You may not be at maximum income because it takes time to get there, but it should be on pathway now. Collecting employee executive definition of financial goals. Okay, so this is where you do your first retirement plan. Here's my net worth. Here's my cash flow. You model out your saving behavior. You model out your debt elimination behavior to age 100. You put in a milestone, retire at 60 or 65, the debt elimination date, how long you'll support it. You put it all on the spreadsheet. One big spreadsheet. And it starts to give you some clarity around where you're going and how you're getting there. Investment returns, you model in a measly 4%. You don't showboat it. Tax returns are regular. Inflation, use 2%. Those are the 3 assumptions. And so, has everybody done that if you're over 40? And where are you? And then track it every 3 years to make sure you're making progress. And the beauty of this exercise, it's just cash flow and taxes and goals and just a bit of Excel, zip, zip, zip on a Sunday night. But what pops out of there is, okay, you need to save $22,000 a year. You need to pay down your mortgage by $30,000 a year. And your investment returns on all of your savings need to average at least 4.5% a year. If you don't get 4.5% a year, the plan doesn't work. So guys, have you averaged 4.5% on your RSP the last 10 years, 5 years? You need to know that. You need to know that. You need to make every investment advisor you have produce a performance report, 1, 3, 5, and 10 years after fees consolidated. They can all do it. If you're just getting crappy month-end statements that show you market value, that's not enough. You need performance data that we've all been able to deliver for over a decade. So pull that report out, be a good accountant if you are one, and effectively tie them together. Tie the portfolio to the cash flow forecast, to your children's savings, and make sure you're getting where you need to go. Let's keep going. By 40, no unfunded RSP room. Time to catch up. Targeted annual RSP TFSA new savings mortgage payments. I just said that, right? How much do we need to save? Quantified. Age can we retire? Quantified. Can we buy a vacation property? Maybe. Let's look at the cash flows. Do we need 2 incomes? Maybe. Let's look at the cash flows. Better disability insurance because the work stuff is crap. Kids halfway to university, and you might have elderly parents. So at 40 is kind of the start, the marker and the standard. Let's start to be more serious about our finances. We're making better incomes now. We have more kind of leeway. We have 2 incomes again. We're getting some breathing room. So let's now kind of, because you know what? When people come to me at 35 and say, we're ready for the planning, it's like, are you sure? Because, you know, it means that I'm going to give you thresholds and I'm going to judge you nicely with a smile. But I'm going to judge you on the fact that you didn't save enough last year because you're paying me for that. So you got to be ready for that level of discipline, accountability, and transparency. If you're not, then don't do it yet. If you're just not there, you've floated through a couple of jobs, you've had some uncertainty, your marriage is rocky, then don't make it more stressful by doing this exercise. I am 80% psychologist, 20% money guy. It has to work for who you are and where you're at. The problem is, if you all of a sudden wake up one day and you're 50 and you've not done anything, it's not too late. Sometime is better than never, but you just have to be realistic at what it's going to do to your goals, right? You've already had kids later in life than most generations. You bought more to a home than most generations. It's already been pushed back. We just need to be realistic about it. This isn't about right or wrong. This is about having the right information in your hands to make the best decisions for you or the two of you together. Aging parents, let me just put this one up. This is one you don't hear much about, that I'm in the middle of a lot, you guys. You know, aging parents, right? Don't wait until they're 85. So you're at Thanksgiving dinner a few weeks ago, right? And you're looking, and there's your father and your mother sitting on the other side of the table. Do you know how much money they have? What do they live on? What was their annual income last year? Almost nobody knows that. They're your parents. Doesn't matter. They're still independent. They ain't telling you. You're the kids. They're not telling you. And so you have no idea what their financial strength is. Now, some people will, but it's very common that people don't know that. And so then something bad happens, like a stroke, and dad can't live at home anymore, and you're left wondering, well, what can they afford? Because, you know, an assisted living with healthcare support, because he's now a 3-person lift to the bathroom, could be $8,000 a month while mom's still at home. So you can't even sell the house. I do a ton of healthcare consulting because it's part of people's finances. But often when I'm dealing with people in their 40s, 50s, and 60s, the first thing we'll do is their elderly parents at 70s, 80s, and 90s. And they watch this happen. And you know, ideally, even sometimes kids don't agree. So a couple of thoughts on this, you guys, because it's real life. And you know, you'll see it happen ahead of you first, and then you'll reflect on yourself. So, you know, don't wait till they're 85 to ask questions. Know where the original documents are. If you have one question to ask, just say, Mom and Dad, where are your original wills and powers of attorney? And if they say, well, they're with the lawyer down the street, is that lawyer even still alive? Do not leave original documents with a one-man or a one-woman practice, because I've had 2 situations where, well, they're long gone. Where's your originals? No idea. Up-to-date wills, I'll tell you, we do a lot of estate work, and a handwritten will, a will from 20 years ago, are all just things that, as long as the older couple is still able to do, should be refreshed. Because it's just something that the financial system that I'm part of will just be skeptical. You'll roll in with the will or with a power of attorney. It's 20 years old, and we'll say, how do we not know there wasn't a newer one done? And you're not a kid that's disgruntled with your parents and trying to take over their money. You will get resistance. I could tell you stories for an hour. You want to make sure it's fresh. And on the flip side of this, if you have no idea, or you know your parents have not had this stuff done, it's out of date, you got to get them to a lawyer before you notice memory slippage. Because they're going to sit down with the lawyer, and the lawyer's going to say, count from 10 to 1 for me, please. Who's the current Prime Minister of Canada? They're going to quiz them. And if they can't answer the questions, you're never getting estate documents done again. Don't wait. Parents moving in with you, they move in with your sister. All of these questions we don't think about until we have to. Even if they don't agree, my parents in rural Manitoba were resistant to leaving their house. Doesn't mean we didn't go look at places just in case, because if a healthcare happens, the hospital doesn't want them in the hospital after a week. You got to find a place there. So it's just do the legwork, take your brothers and sisters. Do not do it on your own. Never do it on your own. Because your brothers and sisters, depending on the relationship, may look at you and say, what's she doing? And it's just not good. Do everything together. Okay, guys, moving on here. I'm running out of time. I'm not done yet. This is not good. Hang on. We only got a few more left to go. Just when you thought it couldn't get any more exciting, let's talk about dying. Never do it yourself. Never, ever, 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 ever do your own will. It's the culmination of your whole life. Spend $500, $1,000, get a will and the power of attorney done. Do not, shortcut it just because you want to save a bit of money. First will, power of attorney before you have a child. Usually, if your relationship goes well, you don't buy a business. The next update's when your kids are 25. 25 years later. Otherwise, a divorce. You buy a business, possibly you set up a corporation. You might need to reflect on that. Your first power of attorney when you're 18 years old. Why? Because if you fall down your bicycle and you have a concussion, you don't wake up for 6 months. A power of attorney is the legal document that lets people take control of your finances at age 18, not at 35. So, that's more relevant at a younger age. Make sure you update all the beneficiaries on your life insurance, your TFSAs, your RSPs, to make sure they're either people or an estate. And before you make those decisions, just kind of real quickly, there's tax issues, legal issues, practical considerations, cash flow, funding issues. They require thinking, and start with your parents and what they put on theirs first. If you're an American citizen, know you've got extra complexity on estate planning that needs to talk to a cross-border specialist. And if you've got a second marriage, third marriage, eighth marriage, whoa, you need specialized planning for sure to make sure you protect the kids from the original couple. So that was pretty painless on estate planning stuff. Estate planning is icky, I know. It's real life, we all know that. And it's sometimes hard to talk about the older generation. So if you're struggling with that because they won't listen to you because you're their kid, and believe me, I had 2 best-selling books in Canada. You think my mother would show me her will? No way, because I'm still her kid, right? But she would show Shirley across the street, who she coffeed with for 40 years. So effectively, Shirley got all the answers I needed. There's always a way, you guys. All right, last chapter. We just blew through career, cash flow, taxes, estate, insurance, real estate, debt, kids, parents. We got one left, investing. By design last, because it belongs last. You can't buy a product until we did slower all the stuff we just talked about. We just set the goals, we just set the priorities for your cash flow, establish the limits on saving, build the plans and forecast where we're going, put the goalposts in the distance, and then we can come out of that knowing what we need our money to do for us. So, basically in this case, now we know how much you need to be in the stock market based on a plan. And then we can get into returns and all that good stuff that we cannot possibly cover off in 7 minutes. But overall, we're going to try. So for the most part, here we go. Let's dive in. By the way, just to set the stage for this, you may think, well, okay, you're a CPA, but what do you know about investing? So my business here will be up to probably almost $1 billion of assets under management with my team of 9. So we manage money for charities, endowments, pension funds, private citizens for over 25 years. So everything we do behind the scenes is part of the broader planning package, but overall, hopefully we know a little bit. So only take into my world on the investment side here and give you a couple of tips just on, again, structure. We're not going to get into what's going on out there right now, but here you go. So first of all, let's put the slide up. You got to divide your money by purpose. So I got a pool for my kids. I got a pool for my retirement. Maybe I manage my elderly dad's money. So you got 3 different plans. You also sit on the church board where you're on the investment subcommittee. You might have 4 different plans. So you build 4 different plans. And so, then you say, all right, well, what are they? And what are the purposes of them all? Goals, right? Define the goal. Then step 2 here, investment math. How much do you have? Well, I got my RSP, my TFSA. Okay, wait, I only want the money focused on retirement. I got my plan of work, add them together, you and your partner, and fill in 2A. Here's what I have. How much will you need? Well, that depends on where you're going. What kind of quality of life do you want to have in retirement? Right now, when I add up your paychecks, you're taking home $110,000 a year after tax. Do you want to have the same 110? Well, no, there's kids costs in there. But yeah, maybe you'll want a higher travel budget when the kids are gone, maybe. Got to think about cars, got to think about mortgage payments, got to think about savings, all which will be gone in retirement. Guess what, guys? In retirement, I'm seeing people spending about the same as when they were working with a different mix. No mortgages, no savings, no kids, no life insurance, higher travel budget, paying for cars and repairs and maintenance in there. So no way are your costs going way down in retirement. Honestly, at least in your 60s, they're about the same because you spend a lot in your 60s. So how much will you need? You can quantify that. How much will you add per year? What are you going to save per year? How much is your employer going to give you? And what's the required? That's new. What's the required rate of return? Because you did the plan and you heard me say I'm using 4 to 5%. The plan works. You need 4 to 5% consistently to make the plan work after fees. What are your investment fees? But all of a sudden, you've got quantifiable data that gives you big teeth in going to the investment portfolio and saying, okay, this is what I need. This is what I need to execute to make it work. And it's not just for retirement, but for every one of the goals we identified in the last step. Risk profiling, the Securities Commission stuff. Greedy brain, I want as much as possible. Cautious stomach, no more minus 20s. This gets a lot louder the older we get. Kurt's financial math. There's just 3 different ways to look at your risk profiling that you sign off on your application forms and that the Securities Commission audits me for. And so effectively, if fixed income offers 3% a year, now again, if equity offers 8 to 10% average over time, don't get discouraged by just this year. Blended portfolio produces what? When you mix the equities and the bonds together, basically every portfolio, guys, every portfolio is 2 groups. Safe stuff, bonds and cash, GICs, risky stuff, the stock market. That's your 2 choices. Never mind rental real estate, we'll leave that out for today. How you put them together, if one pool averages 3% and one pool averages 8%, but one has big drops, put them together to get an average return that speaks to your plan. If I go back to what I told you earlier with the couple, we laid all their statements on the table. One of the questions I asked them was, how much do you have in the stock market? Do all of you know, when you add up all of your accounts at work at home, how much do you have in the stock market for your money and your kids' money? I already picked on the RESP. Shouldn't be in the stock market, the kid's 17. But for you, if you're 42, 52, 62, how much are you in the stock market? And what's the right answer? In the old financial textbooks of 30 years ago, the answer was your age should be the percentage you don't have in the stock market. So if you're 42% of your money should be in bonds and GIC safe. Now that might be a bit out of date thinking, but the common sense is the older I get, the safer I should be. But you need to know your asset allocation, safe money, risky money, and you need to know it every year. And you should be the one setting it and knowing what it is. If you don't know right now in your RSP how much is in the stock market for the last 3 years, that's not good overall, because it then ties into your retirement plan, right? Step 4, let me put this back up. Product selection. Cash, bonds, stocks, real estate. Beware. Advisor compensation leads to bias. Impact of 4 licenses. I can't possibly talk about all this stuff, guys. Here's the main messages on the slide. If you look at your RSP right now, and if I was sitting with you and said, tell me what every one of these products are, tell me what each one is. If you can't, you need to blow it all up and start over. You should not be buying things you don't understand. That's the best tip I could ever give you on investing. If you had bought shares in TELUS the last 3 years, 5 years, 10 years, versus that mutual fund, you'd be a lot happier. And you get more of the dividends because the fees are lower. I'm not saying there's a better type of security. I'm just saying transparency rules. You'll sleep better at night. You'll probably get better returns because you'll understand it better. And you can see how it'll fit in your portfolio. If I have a telephone stock, maybe I buy a bank stock alongside that or something like that. The only other thing I'll say on products, stay away from mutual funds. They're too expensive. There's no transparency. And effectively, if the fees are 2 to 3% a year, that's too much going to fees when you need that to go to your retirement goals and your children's savings goal. And mutual funds are simply baskets of stocks or bonds. Just get rid of them and buy either ETFs, which are cheaper baskets of stocks or bonds, or individual stocks and bonds if your portfolio is big enough. There's different advisor licenses in Canada. Ask them what their licenses are. And just be aware that if you're at a dealership where they're selling just their product, that's a bias that you want to be sensitive to. Maybe there's better stuff out there. Step 5 here, let me put this back up. I'm almost done. Step 5 is measurement and monitoring, rebalancing once or twice a year. If you have an advisor, you should be sitting down with them once a year, 1 to 2 hours, full-blown review on everything, not the junior staff, not a phone call, not a newsletter. The people you hired and you're paying the fees to. And if you're going up and down in the market, 5B here on the slide is, how are you rebalancing? This is one of the most powerful questions I can answer. 2021 last year, The stock market was up 25%. That was a huge, good year last year. Did you take profit? Did you rebalance? Because we're all told, you're buy low, sell high. So last year you were at the highest numbers in the stock market in the history of the world. Sounds like a good time to take off a good 10%. Did you do it? Why not? That's a great question to reflect on. Why didn't we sell when we made so much money last year? And now you're down 25%. Are you buying? Why not? So food for thought. Step 6 here, back to the big picture. So this is a 6-step process to building an investment portfolio. Define your goals, calculate the math of what you need, set your risk tolerance, pick your products, rebalance periodically, and step 6, pull back to the 20,000 foot level. You guys have just been through a quick hour on your holistic financial plan where the advice is integrated between, savings and debt elimination, children's goals and retirement, how long you keep the big house, how long you work. It's all tied together. Everybody needs integrated holistic advice, comprehensively thought about. We just flew through it in far too little time. It gives you a sense of how to look at it. Everything, go back to the picture and tie it all together. So overall, let me just wrap this up. Back to the big picture. It's a year later now. We're sitting here a year later. What's new? Birth, death, marriage, divorce, career change, health issues, other. Did you win the lottery? Newer change goals. Well, now we want to buy a boat. Results versus portfolio, where our 5-year returns are lagging the index. So we fired our financial advisor because we need 4% to reach our retirement goal. And, we're down, but we're not worried about because it's not for any terrible reasons in our portfolio. You got to evolve. Everyone needs to evolve. You're never the same person year after year. So guys, last slide in closing. As we reflect on all this, as I took you through kind of my life in financial services, dealing with white collars for 30 years, you've got to be involved in this stuff. No one will care about your money as much as you do. And engaging in industry in Canada in financial services, which I'll be kind and call it lightly regulated, lightly qualified, you can't trust anybody. You need to let them earn it through all the things like engagement letters, credentials, years of experience, transparency on fees, defining your goals. You know what the answers are. If they don't want to give that to you, you should move on. But until you're happy with that, don't trust anybody. You need a holistic integrated plan. There's no standalone financial decisions. If a financial institution just wants to sell you insurance without contemplating what you can afford, no, don't buy it from them. Go somewhere, they'll give you the bigger picture. Don't let your spouse do it alone. You can, but make sure you're involved at the strategic levels and all the big decision making. Stay away from old school financial advisors that don't have credentials, that don't belong to professional associations, that basically sell one company's product. Integrate the planning and tie it to your goals. That was a clear message, right? Financially, setting targets is huge. Retirement cannot be just kind of hoping I get to some number I don't know. You need to quantify it, and it's doable. Even though you don't know what gasoline will cost tomorrow, you can pretty much suggest that you need $1 million or $2 million for retirement and work your way towards it. And the message isn't to do the plan once and get the perfect solution. It's revisit every few years. It's a road where you're putting guardrails to stay on top. Know the fees you pay. Everybody needs to know the fees you pay in your financial advisor if you have one. Our fees in Canada are among the highest in the world. And if you're paying 2 to 3% a year, guys, that's too much money not going into your goals. You need to bring that cost down to 1 to 2% at the most. And that's assuming you're over, say, $250,000 of investments. Transparency, ask tough questions. You guys, that was a power hour on your finances. Get involved, stay involved, ask tough questions. Don't get emotionally linked to advisors that you lose your objectivity. We work for you. Fire them if you need to, but otherwise, quantify your goals and measure it regularly. And thanks for the opportunity to talk to you.
Thank you. That was a lot in an hour. I appreciate it. So a couple things I wanted to touch on that you mentioned, and then a couple questions. And
Sure.
I open it to anybody else that has questions. Please type them over to me, and I'll make sure we get them into this Q&A. So you mentioned that back in the day there was $25,000 wedding gift, and now you have to add a zero. So I am going to go home and call my mom, because I grew up in Saskatchewan. I got no wedding gift of any dollars. So
let's not make this about you.
I did wrong. Why am I such a bad daughter? But I think it's those little things that are actually big moments that are really good points that you raised. So I did have to write that one down and ask where my money was. It's funny though. Someone the other day called me on his way home from meeting with the financial advisors, and his response was, it's so depressing talking to a financial advisor, because it's all about death and giving money to your kids and all these things that are so far out and that you don't want to think about. And just curious, obviously no one, to your point, wants to talk about their kids leaving them or growing up. We want to live in this beautiful world where you get to go watch and play hockey every weekend, and you don't want to think about how much it's going to cost when they're adults and how many degrees they might need in this new world.
Yeah.
And you certainly don't want to think about your parents aging and what impact that has, or whether or not disability could come. And so these are really tough conversations to have. And I'm just curious, how do you work with your clients to make sure that you can have an optimistic perspective of financial wealth and the wealth part of it while addressing these hard topics?
I'll take the opposite and say we're too much living in the moment. We're too much planning vacations. We're too much planning renovations. We're too much, buying the expensive red wine. Like, you got to do that stuff. This is about balance, right? You got to have a life. As I said, I'm 80% psychologist. I got to put the carrot out just far enough to motivate you, but not so far I demotivate you. Because it's easy enough to say, I don't want to work with Kurt. He's too depressing. He's making me think about stuff. So this is a challenge to find the balance of, letting people have the life they want, but also making sure they're taking care of the loose ends. And, things like estates and wills, that might be twice in your lifetime. Things like setting up your insurance might be a couple times in your lifetime. Things like taxes and investments are every year. So this is also dependent. Every one of those topical areas is not every year, every day, right? But I think the danger is that you spend everything you make without taking time to plan for the future. It can be pretty disappointing. And I think a lot of white collar professionals that are coming into their 50s, they're seeing a lot of kids' costs ahead and still having mortgages. And retirement's still just, I'm doing the basics. I'm saying the basics won't cut it. Do the math and see where it is. And you know what, frankly, it might be too late. You can't catch up, but even that's okay. It's just make sure between you and your partner where you're at so you can set realistic expectations if you're working to 65 or 70.
Yeah, that's good. Those are really good points.
It's not just going to magically happen at 60 because you turn 60. That's the old way of thinking. But sorry, Dad had a defined benefit pension 40 years ago. You don't.
Yeah, no, and that's certainly defined benefit pension plans aren't that popular anymore. And those of you that have them are lucky to have one.
Well, and if you're not government, you may not even have them in 10 years because they're ripping them out left, right, and center.
Yeah, definitely. So you heard it here first that real estate prices are going to go down next summer. Kurt mentioned that, so that's exciting.
That's not good. I'm not here to give forecasts, though.
No, I know. I'm just teasing you. But one of the things you mentioned that I do want to explore a little bit more. You made a comment about if your advisor is selling products only or starts with products and it's about buying products and then having hope, that's a sign of a salesperson and not advisor. And I think that deserves a little bit of extra repeating, in that a lot of us are looking for that wholesome approach to our financial wealth and to go to someone that can be a true advisor. But there's also a lot in the market that are very much driven to sell certain products, and in fact, they're only authorized to sell their own entities' products. And that is a salesperson job as opposed to an advisor job. And so you did a great job of already touching on it, but I really think I want to hear it again for our members. What's the signs of a salesperson when you're going to find that wealth advisor? And what's the signs of an advisor, which for most of our members is what they actually need given.
So let's start with designations and belonging to an association. So in Canada, for wealth management, financial services, insurance, there's probably 5 to 10 different designations, none of which are a national standard. None. As a matter of fact, it's quite the opposite. You can create a designation in your garage, offer it and sell it to the marketplace, give them a big plaque to put behind their desk, and that's legit in Canada. So, if you look at, if you guys get these slides, if you look at my name on the bottom of the slide, I have 9 designations. If I threw one in that's fake, you'd never know. Like, that's how bad it is in personal finance. It's unlike doctors, lawyers, dentists, and accountants, where there's real credentials, real programs, real experience, real associations. Canadian wealth management really has none of that. It's largely off the street, get a license and sell. And so unless you're holding feet to the fire and saying, what designations do you have? Do you have your CFA? Do you have your CFP as two kind of standouts that are good? For insurance, do you have your CLU? Do you belong to the National Association for the Financial Planner Standards Council? Because they don't have to. It's not required to belong to any association in Canada. It's just not. And how many years of experience? Can I see a sample financial plan you prepared? Have you ever been audited by the Financial Planner Standards Council? Because I would like that. How is my accounts insured with you? Do you belong to CIPIF or CDIC or Assurus so that I'm insured for $1 million per brokerage account? Do you use an engagement letter that defines my services, my communication, who's on the team, who I'll hear from in my fees? Because service letters are not unique to accountants and lawyers. Good planners do it. Google them, you'll see. I think we all know what the answers are to quality solutions. Do you disclose your fees? Do you give me a once-a-year performance report that on the top right corner shows me my rate of return last 1, 3, 5, and 10 years? Why wouldn't everybody want that? So I think that if you're being led around by a financial advisor who doesn't give you any of that stuff, you're kind of to blame too. In a way that the good news is you can change that right now by asking some tough questions. Flip an email right now. And I think what you'll find is that you'll make them squirm, because if they don't have a lot of that, they don't want to answer the questions, and the writing will be on the wall.
So I think, further to that point about what to expect and taking some of the responsibility and blame, I think a couple of times you talked about the importance of being there with your partner or spouse, if you have one, and making sure that you share responsibility accordingly. And I just want to tell a quick story of my own and hear your thoughts about it as well. But you reinforced a lot of my own experience in what you said. So obviously, as a CPA and someone who does forecasting and does numbers and money from a corporate perspective, not a personal perspective, there's a part of like my financial wealth planning that kind of comes from gut, right? And so a lot of the conversations that I would have with my husband, I would be based on gut, and I would just feel like, it's, well, obviously we're fine, or clearly that's appropriate, or that's sufficient, or we can afford that. And I would speak with these generalizations that weren't very specific. And what I didn't realize is I was causing so much anxiety to my husband, because he wasn't sharing that same background. He doesn't do forecasting and numbers. He has a math degree. He's far better at numbers than I probably am, but he doesn't look at it from that angle that I do on a regular basis. So he wasn't sharing in my comfort. And so it was interesting, because during the pandemic, we had this 90-minute meeting with our financial advisor. And so my first thoughts when we came to the meeting was, I don't know why we need 90 minutes. I don't have 90 minutes worth of wealth to talk about, was my first comment, right? Yeah. And then there was 5 people on this call, and they brought a lawyer and an accountant and my advisor and the person that did the plan and assistant and me and my husband. And so the second thing I was like, I don't know why you guys have so many people. I'm not wealthy. You guys have better clients to work with. But it was interesting, because then we went through this process and this meeting. And my thoughts were kind of like, oh, thanks, you stole my watch, and now you're telling me what time it is. Like, this is pretty common sense. Everything's great. This is a validation meeting. This is exactly what I expected. But what I didn't realize, and what I want to express to everyone as members, because most of us do have spouses and they may or may not share our same financial literacy, is that or experience, is that plan and the graphics and the way the table's set up and the visualization and the narrative, it's a very all-inclusive plan. It's a very long, big plan. JD now looks at it and he says to me, he's like, hey, we're on track. We actually hit our 2022 goal last month. Or, hey, we're hitting the mark on the month to month. And like my marriage has never been better. And so I want to like reemphasize to a lot of our members who maybe don't see that they need that actual versus plan, or that detailed plan, or that 90-minute investment meeting, how incredible it can be to be on the same page, to have the messaging and communication be different for the audience, which probably you and your spouse do need different messaging and different audience and different narratives to get the message across. And you mentioned a lot of times the importance of that. Compare your actual plan, document that spreadsheet or that plan. And I think, from my perspective, that was a bit resistant, because I felt like I had it right in my gut. And thankfully, it actually is pretty aligned. it's made a major difference to my family and to my marriage, and then therefore my own stress. So I really want to point out how important that time and that effort is, and to have those expectations of your wealth advisor. And so, Kurt, I don't know if you have any thoughts on that, or similar stories that you'd like to share.
Well, what I would say is that I've written 7 books. I've been teaching for 16 years. I'm passionate about this stuff. In all my courses, I start off by saying nobody needs a financial advisor. A lot of this is common sense and about 4 to 6 hours a year of involvement if you have good systems in place. So I teach self-empowerment. I'm saying, particularly if you're financially astute, then for sure you can figure this stuff out in most cases. But not everybody, frankly, wants that, right? Not everybody wants to spend time sorting out, doing their own tax return, or trying to do their own will and pick their own stock. So I respect that as well. But I think there's been a lot of focus in the last 10 years, deservedly so, on what is the value of advice and what's worth paying for. If you've ever seen those Quest Trade commercials on TV, which are hard hitting, and I love them, frankly, we're saying stop using your dad's financial advisor and do it yourself, and go to Robo or go to Discount. I love those because they focused initially on just investments, where it is $9.95 to pick a stock or buy a GIC. If you've got a little bit of financial wherewithal, you can do that. That shouldn't be where the emphasis is on what to pay for. And I'm glad to see the cost of that coming down. People that are putting 3% a year into mutual funds need to stop. But then the question is, what's worth paying for? So if I've got a husband and a wife and they don't always see eye to eye, or one is more intimidated by the finances, the neutrality and objectivity of an impartial person who's not, related to the couple or related to the elderly parents, that's probably where the value proposition starts. Talking about retirement goals, estate, all that, doing insurance analysis, children's savings, bringing 25, 30 years of experience to that, and coaching people on strategies that require education, knowledge, and experience is probably where the fees should be focused, and it's moving that way slowly. The problem is the product world is so massive in Canada that everybody still comes into it. No, I'm going to sell it. I got to sell an insurance policy. So you'll sit down, you'll see a client, they'll get a business owner that gets an insurance proposal. And it's like, okay, well, my insurance agent thinks I need this permanent life insurance in my holding company. Well, why? Well, because it's a tax shelter. Yeah, but why don't we start with the conversation about what are your estate goals? Let's talk about whether you can afford that huge premium when you haven't even maxed out for retirement yet, or finish helping your kids. The biggest thing you want to avoid in Canada is concept selling, which is get you in a room, beat on you to buy a product in one lane way when the whole thing needs to be tied together. I end up canceling so much life insurance because those are expensive policy purchases, and to buy one, you got to basically assume your life won't change in 50 years. Well, who can say that about any life, right? So it's something where I think that if you are a little financially astute, yeah, you can do this all yourself, maybe with the exception of detailed insurance planning and product quoting. But overall, then you got to say, do you want to? And if you don't want to, then you got to come at it and say, well, what's worth paying for, and how much do I want to pay? For 80 years, financial services in Canada has force-fed the consumer financial services, often hiding the fees inside the products. Only when you got to higher net worth and you start to pay as a percentage fee on the outside, do you even start to know what you pay. It doesn't have to be that way anytime. You can ask today, even at $25,000, explain to me how my fees work. As a matter of fact, the regulations changed a lot, even the last 5 years, for us to require to do that and be more transparent. So it still comes down to, though, the consumer saying, I care, I have a lot of questions, I'm not going to be easy, and good for you. That's what needs to happen. An industry that for a long time has looked down their nose at you and said, I'm not going to tell you what the fees are, I'm not going to give you a rate of return, I'm not going to ask you what your goals are, I'm not going to give you a financial plan, and us just saying, okay, like that's not going to work anymore. And overall, we need to hold them all far more accountable. There's lots of good people in the industry all over the place. You just got to find them.
Yeah, my next question is about, that pushing of assumptions and products that we see so often in these financial product sellers, or they like to be advisors, but I'm questioning their ability to advise sometimes, because that assumption that everybody wants to retire like Freedom 55 or 65, which we know that, those numbers were set when people were doing far more laborious jobs and the life expectancy was far shorter.
Yeah.
And so, to try the amount of times you go to a financial advisor and you try to talk to them about like, listen, I don't intend to retire potentially ever. And so for me, saving is about protection in case I get forced to retire, going back to, your disability insurance, which I think is definitely low hanging fruit for all of us for sure. So first of all, there's that assumption that people are going to retire and that they actually want to retire, which is, I think, great. That's a great stereotype, but not necessarily everyone's truth. You alluded to people not being able to, even if they want to, but I think there's also those of us that, intend to have second or third careers, whether it be on boards or advisors or consultants or what have you. And then there's also, this RSP, which is a great talk about product selling. There's I have some skepticism personally. I saw my grandpa, who was not wealthy in any way, but a farmer, and, making a lot of investments in RSPs because it was pushed. And in the long run, did not think that was the right decision for him, because his income, even as just a retired farmer, did not go down. So the whole concept was kind of flawed, because the idea is that you defer, and we know that deferring is great in its own self, but the other side of that concept is that you defer to when you have a lower tax rate, which is, again, an assumption that is not necessarily playing out for anybody, let alone white collar. So I want to talk a bit about, like, how do you get creative? And I think it goes back to what you said about goals, but it bears repeating. How do you get creative about not just pushing RSPs because that's the product of Canadian choice, or pushing the retirement age because everybody must want to retire at a certain age? Like, get more creative and think about what actually makes sense for the individual.
I don't come into it with any kind of stereotypical ideals that have been established in the past. When you think about retiring at 60 or 65, where did that come from? Is it tied to just when CPP might start? I don't know. It just seems it's one of those things where we all have in our head that that's where we deserve to retire. And I come at it from maybe, but we need to look at this when you can afford to retire, and you might have to work longer. But you're right, that doesn't have to be a bad news story. In today's world where everyone's educated or overeducated and motivated, you can find something part-time seasonally that you like to do and make a bit of pocket change till you're 70, 75. That doesn't have to be an awful story. Can be a nice way to bridge into better cash flow and less stress about the stock market once your paycheck stops. So that's, I think there should be flexibility there. But the attitude of, well, I'm just going to keep working because I don't have enough money now. The danger of that is, but a car accident or a heart attack could change that tomorrow. So even if you want to keep working, you kind of still got to get to certain points by, say, age 60. It's just a number I'm picking. And then hopefully you're working your 60s after you're financially free for the love of it and for the flexibility of it. So that's just an important distinction. I think what you accumulate in terms of rental properties, small business, RSPs, TFSAs, corporate, trust, personal savings, for me, that's a tax answer more than anything else. And we don't have enough time today, but definitely I have upper limits on how much I like to see people put into RSPs by the time they retire, per person, even within a couple, because to your point, you can end up with a lot of taxable income in your 70s and 80s that is not very tax friendly overall, particularly if one spouse dies and you inherit theirs as well. So I think it comes back to, you got to have a multi-level plan that factors in goals, taxes, of course, to date and in the future, investments, investment returns, spending limits, all your 6 different income sources that you could have. It's all going to go into one thinking that you update regularly, because none of us are standing still and the environment's also changing around us.
Those are really good points. I'm going to just grab on to something that you said earlier in your presentation and that you just talked about here too. You talked about here that idea of working when you're at that certain age and finding something that you love and contributing. And earlier you mentioned that 50-year-old scary point where you're at risk of being let go, and you were talking about it from the perspective of being that 50-year-old and having that security. But just as a big plug for our recruiting department, if you flip that over, there are some, if you take ageism out of your hiring, the ability to hire and get these amazing professionals onto your team is really something you need to be thinking about. So if we just flip it from your business leader seat and think about some of the things that Kurt said and where the opportunity that is as a hiring manager and a business leader to get a hold of these people that are at their prime in terms of professionalism and their career, and what kind of experience they could bring to your team overall. And too often, one of the things that bugs me is people looking to hire underqualified or certain ages. And I just feel like it's a lost opportunity many times for our clients. So I really wanted to pick up on that and turn it around from the business perspective. So going back to the overall conversation, you mentioned that you got 2 kids. I think that's what you said. You said you can't have 3. So, and I saw 2 girls behind you. So I believe it was 2. What if they're only going to listen to dad for 7 seconds, because God forbid they're not going to listen to you for 12. What is that one thing you're going to tell these ladies when it comes to financial wealth and being prepared?
Oh, this is an interesting one, you guys. Stick around for a few more minutes because I got a doozy to say on this.
Okay, awesome.
So
That's 7 seconds, but I love it.
This financial literacy stuff that I mentioned, right, where they don't teach it in high schools yet the way they should. So in my practice, I'll tell you a story. In my practice 10 years ago, we started something called Money University. So I wrote a curriculum that we started offering to our clients' kids from ages 14 to 28. And it's been a big hit. This past summer, we had another 40 kids go through, where as they age, kind of building on the good stuff parents would be doing, we teach them investing, we teach them first job finances, we teach them moving away from school, like all the stuff you'd suspect. And it's very rewarding and we appreciate it. And most of the kids embrace it. And it changes over time. It's even interesting when they get in their 20s, when they push away from their parents, they stay with us, and that's good too. But my expectation is that they will only build on that later in life. That we will get them to start, but then when we kick them out of the nest, they will continue to grow on that. But you never know, right? So I had my eyes opened last year when, in this case, it was a young lady who had been through that with us. She got married, and she came back with her husband for a joint session to say, well, I have my money with Kurt's team from the olden days, and now he's in the picture. Right? Well, they actually came back to announce that they will be moving her accounts away from us. So they were basically meeting us to say goodbye, and moving it to another place, his financial place, whatever it was. And what was heartbreaking to see in that was she verbalized the fact that he would be now taking over full control of all their finances, and that she was basically happy to they were married now, happy to turn it all over to him. And that's just the way it was going to be. And that's her choice, right? That's the relationship dynamics of who's going to do what. I guess and again, building on what you said with 2 daughters, in this case, it just resonated because I do too much divorce work in people's 40s. I do a lot of divorce work. And I see the power that the one who is more financially astute often has over the one that let go of it or never had it. And it bugs me a lot. So I just think that even if you don't pay the bills every day, even if you don't pick every stock, that's why I said subtly in my course here is that you need to be involved and know where it all is and know what's going on at a high level. Hopefully that never happens to you, but never let go of the control part. And to do that, you got to have a bit of financial education along the way.
I love that. I love it because Oprah said it first. And she constantly would tell all of us as fans growing up as children watching her that exact thing. Do not let go of control. Do not know what's going on. So she said it first. Kurt repeated it today. It's still applicable in 2022, years after she went off the air. And it's a really good reminder for all of us, because God knows when you have someone that's willing to do that work, it is nice to wash your hands of it, but that doesn't stop you from needing to have that strategic at least high level overall view of what's going on with your finances, which is part of the family. So that's a really, really great point to end on. I appreciate all of you attending today. Thank you so much for all of this information.
Well, thanks everybody for stopping by.
We'll be sure to share this video, which maybe you want to share with your spouse now that we ended on that note. You can also expect to see the slides coming out. As I mentioned at the beginning, November is a great month. November 3rd is a live presentation, Take Back the Edge. It's about the CPA profession and the CFO role. So please do make sure to register quick. We do expect to sell out November 3rd on that live evening session. And we have on the 3rd Tuesday a session on leadership, which will be a really great session. December, we take off because of holiday season. In January, we were back with Janice, who's going to do an IFRS update, and that's always a popular session. So we're excited about January. And then February, we are going to be doing cybersecurity and thinking through the mind of the criminal so that maybe we can protect ourselves better and also find out about this fascinating world of cybersecurity from a different angle. So lots happening with AHA. Make sure you stay tuned. And thank you so much for being members and attending today. Much appreciated. Thank you.
Bye.